Howdy there, folks, and welcome into the garage. Got 3 videos to react to here tonight. I'm very excited to get into these 3. Okay, first one, Jim Cramer says avoid the house of pain, which is the NASDAQ 100 or the NASDAQ in general. Okay, I want to talk about that a bit. Second video up here, bank stocks will rip after the macroeconomic headwinds are over, says a gentleman who works for Wells Fargo. That's interesting. Okay, in all seriousness, we'll speak about that. I want to hear his points and talk about my perspective from that. Then we got a Josh Brown video from today to react to. The path of earnings doesn't necessarily tell you what stocks are going to do. So we'll watch that one. I'll kind of give my 2 cents on that one here today, okay? Now, this Jim Cramer video, we'll just get straight into it. Hope you guys enjoy this as always. Thanks for everybody for being subscribed. 15,700 plus subscribers. You gotta be flipping my flapjacks. Somebody got on me earlier for not shaving. I apologize about that. They said, get a haircut and shave. You look sloppy, and I apologize, okay? Haircut coming soon. Shout out to the person that got 100 comments or 100 likes so I can get a haircut, and I'll shave soon. But man, people are always on my appearance. My wife and I were talking about this recently. People are really on my appearance serious, man. When I turn 40, that's when I'm going to get serious, okay? So whoever works for CNBC didn't put enough of the clip into this, unfortunately. It's like 1 minute, and then it's just like an ad for CNBC after that. But basically, Jim Cramer on Wednesday explained why investors should avoid owning stocks in the index, okay? So he explained that, but unfortunately they put the wrong clip or they just cut it off way too soon here, okay? So here's my perspective on this, all right? I pulled up the past 25 years of the NASDAQ, okay? In the past 25 years. First thing you got to understand is that the NASDAQ is the premier index that everybody really wants to be in over time, okay? Now, the second thing I think is important is you got to understand, when it comes to the NASDAQ, these stocks in this index do not stay down for very long, okay? So if we go back to kind of 97, 98 time frame, you got, you know, a dip there for a bit, little dip there for a bit, little dip there for a bit, up, right? Then you had the tech bubble, which was several years of the indexes being in a downdraft, right? Now, the tech bubble, a lot of people think like we're going to be in a tech bubble situation, okay? No, not even remotely close, not even in your most bearish scenario is that something that's realistic. And I hope not, because then we'll have like 50% unemployment and, you know, it'd be worse than the Great Depression, so let's hope that doesn't happen. But, you know, you can't even compare the companies of the NASDAQ versus the companies of today. You can't compare Pet.com to NVIDIA. That's just ridiculous and disrespectful and just a lack of intelligence or experience or a lot of different things, okay? You can't compare Amazon of 1999 to Amazon of 2022, okay? They're not even comparable companies. So that whole, like, oh, you know, maybe the NASDAQ could have a couple of years of downtrend, very unrealistic, extremely unrealistic. That was a whole different ball game there where valuations got insanely pushed, similar to what happened in the crypto market. And that's why, you know, the parallels I see between the crypto market and the NASDAQ were huge, right? Where crypto, the belief is it's the future, right? But it's like not really the now. Actually, it's not the now, right? And this was the same situation that kind of happened in the tech bubble. It was all these companies and a lot of them didn't make it, right? But there was this belief that tech is the future. And it was the future. It just wasn't the future then. It had to take time to play out, right? So then as the years went on, right, you got a little dip there, a little dip there, a little dip there, a little dip there. Then you got the big, obviously, crash there, the great financial crisis, right? Up. You got a dip there. You got a little dip there. Boom. Couple few little dips there. Major dip here, which was at the very end of 2018. Boom, up and away. Then you got the March of 2020 crash. Boom, down a straight line, up in a straight line, a dip there. And then obviously this massive bear market crash, whatever you want to call it for the NASDAQ, where the NASDAQ year to date as of right now, 34.2% down. NASDAQ's down close to 36% from the highs it reached in 2021, okay? So the thing I would say about that is I think this is absolutely the time to be buying these stocks and just continue to buy these stocks for the next 6 to 12 months, in my personal opinion. And don't stop. That's the biggest thing is like, you know, you start buying, don't stop for the next 6 to 12 months. You load the boat on your favorite companies because, you know, these discounts don't last for very long. You know, that's just facts, man. Look at the past 25 plus years. Now, if you want to bet on something happening that's never happened before, where the NASDAQ does stay down for many, many years, you can bet on that. It's just going to be likely a bet that doesn't come through, essentially, right? And so, yeah, I think it's a dangerous bet to bet against the greatest tech companies in the world. People have tried it time and time again. It can work for a very short term time, and then it doesn't work anymore, essentially, okay? Alrighty, video to react to here. Bank stocks will rip after macroeconomic headwinds are over. Alrighty. Remember the source, though. This is important. It is a gentleman that actually works for Wells Fargo, but I'm interested to hear what he has to say.
Go to the micro, which you'll see on Friday and next week. The micro is really phenomenal at the banks, and it's very simple, and you can use an abacus to compute this. Revenues are growing faster than expenses. You're seeing some of the best Main Street banking growth that you've seen in decades. And the last time you had inflation-induced revenue growth for banks, headcount increased 51%. 51% in the 1970s. Now we expect headcount to remain flat. And Scott?
Okay, wait a minute. So before we get into further here, that is extremely important what he just said there, okay? He's talking that bank earnings are going to be good right now even, okay? And remember, he works for Wells Fargo, so he's connected with everybody with Wells Fargo. Wells Fargo reports on Friday. So I'm guessing they're going to at least report decent numbers. I don't think that's out of the stretch of imagination, right? It almost seems like, I don't call it inside information because everybody knows this now, but it kind of seems like pretty darn good when he's talking the way he's talking right there, right? And he works for Wells Fargo, and I'm sure he's got a whole lot of friends that work in different departments of Wells Fargo, and who knows if he sees different numbers? You know, I don't know. All I know is that's intriguing. We'll call it that, okay? So, you know, with all these earnings expected to be bad, you know, once again, all these companies have to do is come in with decent numbers and the market will be ready to fly in that situation, right? And so we'll see what happens here, but I think that's pretty intriguing that, you know, you're talking about all these stocks are going into this earnings period just absolutely devastated. And if they come in with pretty respectable earnings, oh boy, that's going to be quite interesting. And when he talks about revenue, basically growing at did he say the bottom line's growing faster than revenue? Let's listen to this one more time.
That you've seen in decades. And the last time you had use an abacus to compute this. Revenues are growing faster than expenses.
Revenue growing faster than expenses. Okay, if that's the situation, that means net income is going to grow at even a faster clip. You know, it doesn't take an accounting expert to figure out that, right? So, wow, that's pretty big there.
Some of the best Main Street banking growth that you've seen in decades. And the last time you had inflation-induced revenue growth for banks, headcount increased 51%. 51% in the 1970s. Now we expect headcount to remain flat. And Scott, I found a relic of banking back a few decades ago, and here's my abacus.
Right.
So what it used to be when banks added loans and payments and processing and servicing, they had to pull out the equivalent of the abacus, little paper forms, and fill them out and hire a bunch of people. Banks don't have to do that. Sure. So for the last decade, banks have invested in technology, and you are on the cusp of seeing the payoff from that investment. The scalability of the bank business models is underappreciated. Banks will be adding revenues at lower marginal cost without adding too many people, more revenues, more earnings per employee. That is why it's night and day difference for the banking industry today than past periods of inflation. And you'll see that starting Friday.
Let me ask you a question.
Wow, you'll see that starting Friday. Sounds like a threat. No, but in all seriousness, that's, you know, people should be paying attention to this, okay? Dude works for Wells Fargo. He's connected with that, and he's basically kind of telegraphing how things are going to be there, right? I think somebody should pay attention instead of just watching all the fearmonger videos all the time. Like, seriously, right? Now, I have had this thought process of like, you know, what if we are in a kind of 2001, 2002 dynamic right now, right? Where you basically kind of had a recession, but you didn't have, you know, an earth-shaking recession. And then coming out of that, the financials actually went on this incredible run for several years up until the financial crisis, which obviously took them all down in a massive way, and some it took out completely, right? And the government had to come in and save the whole sector. So sometimes I think about that, and I think about financials never really had their big run in this whole last cycle, right? They never had it. They never was like, wow, you know, you need to be in the bank stocks. Look at the bank earnings. It was never like that in the whole cycle. And it just seems like, when is it the bank's time? And maybe we're going to get into that time, you know, maybe starting in 2023 or in future years. We'll see. In terms of the banks, we know IPO market's very weak, so don't expect a lot of business there, if any, to be quite frank. And we know housing's definitely weakened in a substantial way. So that's obviously not great for the banks that might loan or, you know, basically have loans in the housing market, right, that are giving loans out there. So that's just some food for thought in regards to that. But, you know, other spaces for the banks could be actually very, very strong. And this gentleman sounds very confident. That works for Wells Fargo.
Maybe our viewers are thinking this and they want to ask you this question. Did Jamie Dimon this week make you want to go out and load up on bank stocks? Did he?
We have the Jamie Dimon paradox. Jamie Dimon has called a hurricane. He said we have a recession. He said, look out. And partly with good reason. I mean, the Fed is tightening.
Partly?
Well, quantitative tightening, the Fed's tightening, and then you have stricter bank capital rules. So there are reasons to be very concerned. But at the same time, Jamie Dimon and JP Morgan, they're investing more than they have ever done before, and they have not set aside huge reserves for problem loans ahead. So which is it? You know, is it his words, which say, oh, look out ahead, or is it the firm's actions, which say, hey, times are still okay? We'll find out Friday.
Well, who's going to do best this earnings season? And the other thing, by the way, is that it's not like JP Morgan, and I don't mean to single them out because you could throw in a couple other big banks with them. It's not like their stocks do all that much after earnings, right? We've learned that the last two reporting periods. They report, the stocks end up going down.
Well, you know, banks have gone down less in the market since second quarter earnings. And I think what you'll see is bank earnings continue to grow. Bank earnings continue to grow even through a recession. So every quarter that the bank stocks stay here, they get cheaper and cheaper. And once you get this macro overhang out of the way, it could be tomorrow, it could be 3 months, it could be 6 months, you're going to see these bank stocks rip. But I grant you, they're in a holding pattern, but 1 year from now, I'll be back on the show, and you'll see Bank America stock won't be at $30 a share. It should be much higher, or at least outperform the market.
Or we'll hold you that. We'll have you back.
Yeah, so that's a gentleman that's very confident. Let's just call it that. Very confident. Okay, so I wanted to go ahead and take a look. I mean, he's so confident, he almost sounds like a short seller. He's so confident. I mean, that's the only people I've seen that confident. All stocks going to zero. I mean, man, these people are really have turned into quite geniuses, as we can see, huh? Wells Fargo. So in terms of this one, year to date, down about 20%. That's better than the market, to be quite frank, to be fair to them. JP Morgan has underperformed the market, down about 36%, so that is worse than the NASDAQ and considerably worse than the S&P 500. Bank of America also worse, much worse than the S&P 500, and it is worse than the NASDAQ as well. So that's quite interesting, but man, the gentleman sounds very confident. That's all I'll say about that. So interesting, okay? All right, next one up here, Josh Brown. The path of earnings doesn't necessarily tell you what stocks are going to do, okay? I haven't seen this one, so we'll see where he takes this here. I'm interested.
It's overcompensating. This is like behavioral at this point. They know how late they were. They know what they've unleashed by not acting sooner, by continuing to stimulate long past the point where we had massive recovery in markets and in employment. They know what they did. So this is like a combination of, hey, let's earn back our credibility. And, you know, I get it. I'm not opposed to what they're doing, but I completely agree with Ian. Shut up already. We got it. We get it.
But I mean, the minutes, right?
I like that, man. I'm so sick of the Fed. These people got to come out and talk every 10 minutes. Seriously, it seems like every other day the Fed, like, I don't remember all these Fed officials, like, are they getting paid for this? Like seriously, does somebody, like, paying them money to, like, just come out and do presentations or whatever? Because I guess I can understand that. If they, like, hey, you know, you come talk at our forum or conference and we'll pay you $30,000 or something like that, I could almost understand that. But I'm like, seriously, why do these folks got to continue to come out and talk about the same thing again and again and again and again and again? Like, I don't understand that. I can't comprehend that. So, you know, like we can hear from them every once in a while, but now it's just at a point where all these different Fed officials are speaking all the time about the same stuff. And it's like, what for? Like, what's this all about?
Finding out sort of what's really happening in the room and in their heads, right? Appropriate at some point to pause rate hikes, excuse me, they say. But many in the room saw the cost of doing too little outweighing too much. And a sizable portion of the economy is yet to respond to the rate hikes. I'm curious to your reaction to these minutes, right? Especially the line of seeing the cost of doing too little outweighing the cost of doing too much.
Well, look, the thing about what they want to do is you're not really going to have concrete evidence that it's worked until months after the fact. And you're not really going to know what the ramifications are and the unintended consequences of moving this quickly, this aggressively until long after the fact. That's just the nature of these things. And the Fed can't do anything about that. So, you know, we want to get to 4.5% unemployment. We think that's more reasonable. OK, so that's 1,000,001, 1,000,002 jobs lost. How fast do you need to bring that about? You need to bring that about this month. So a lot of the things that the Fed needs to have happen are going to lag what they're doing. Like, this is just the way it works. True. I know they know that, too. So that's the game that we're playing right now, and it's not pleasant.
Yep, 100%.
But give me the scoop on earnings, okay? So that's where
Before we get into earnings, 100%. I mean, in terms of the things that it's already starting to reflect, in my opinion, is housing, major. Autos, major, and I think other big ticket purchases such as furniture and other various things that people spend a lot of money on. I think it's already very negatively affecting those. The issue is, like, they're not going to magically, by them raising rates, it doesn't magically make ground beef cheaper. It doesn't magically make eggs cheaper. It doesn't magically make a gallon of milk cheaper and those sorts of things. So that's a frustrating part, is that's a lot of what people are feeling right now. And, you know, with what they've done with rates, it's going to devastate real estate, you know, over the next year or so. And there's going to be massive job losses. I don't know if you guys have seen some of the data already out of essentially like realtors not essentially continuing on the MLS. It's cutting down massively, and wait to see the numbers in 6 months from now, 9 months from now, 12 months from now. Yeah, a lot of folks that were making money in the industry aren't going to be making any money, to be quite frank. It's going to be a very tough time. And for all my folks that are in the real estate industry, you know, it's going to be a tough time for a while, to be quite frank. And that's unfortunate, because there's going to be a lot of jobs lost there, a lot of revenue opportunities lost there, and things like that. So that's just going to be a whole situation has to work through. A lot of people that build these homes and things like that aren't going to have those jobs at some point in 2023. And that's unfortunate, man, because, you know, families are affected by that, right? And, something that really bothers me, and I might speak about this in the future, is all these people, you know, wanting all this devastation in the economy and things like that, and people to lose jobs, so stock prices go down. Just really bugs me, right? It's a different mentality if it's like, hey, you know, if assets get cheaper, I'm going to buy assets, right? Whole different mentality when you're rooting for people to lose jobs, because, you know, that's the families that are affected there. But I've seen some of that sentiment out there, and I read through YouTube comments, and it's always from like the short sellers, and short sellers are the dirtiest people in the world, man. I have no respect for short sellers. Awful, man. Just all of them are almost, I don't want to say all of them, but most of them just horrible human beings. They'll do anything to tear down a company. They will do anything to tear down an individual or whatever. They want absolute failure, and they want people to lose jobs, and they're begging on that and things like that. And it's just sad, man. It's sad. Like, you know, when I take my kids to like sporting related things, right? You know, it costs money to put your kids in sports, right? And I think about, like, if folks lost jobs, like, they wouldn't be able to have their kids in sports anymore. And I just think about stuff like that. And some of the, you know, these short sellers, they have no heart, man. Absolutely no heart. They could care less, to be quite frank. And that's just unfortunate. So,
you know, sort of threw the dice down here on what's going to happen, right? We really kick it off on Friday with the banks, and then it gets hot and heavy in the weeks ahead. What should we expect? Is it enough to, quote unquote, save the day? You got the Fed overhanging everything. So, I mean, the numbers almost feel like irrelevant. The guidance is more important than anything else.
It's a very perverse situation. We want layoffs, and we want caution on these calls, and we want to hear companies retrenching. Like, that's, I mean, I know it's very counterintuitive, but that's what we want, and that's what we're going to get. This is Yardeni data. Q3 earnings are expected to be up 2.9% year over year. The projected growth rate from this past January going into the year was 7%. So we've already lopped off more than half of the earnings growth that was being expected for this quarter. They're also taking down Q4 numbers. Now they think up 6 and change percent. That number was closer to 14% at the beginning of this year. So that work is being done by Wall Street's analysts. You could argue that they should be doing it quicker, but Q2 earnings didn't justify ratcheting down expectations that much more quickly. So it's a very tough situation. And then you've got companies like Pepsi where they're basically like, hey, we're fine. FX headwinds, blah, blah, blah. We're okay. So it's really, really tough to envision a scenario where those numbers drop really quickly. But that will be evidence for the Fed that they're getting their way. One of the main things I want to get to really quickly, Scott, is this. We're getting the question from our client. We do a quarterly conference call, and we say, send us your questions. What do you want to hear about from us? And then myself and Barry and Michael and Ben and the whole gang weigh in. The number one question that we're getting is, if you know that earnings are coming down, why would you want to be invested? And we took that question and we ran the numbers, and this was fascinating. And I don't think the viewers have heard this anywhere yet. If you go back from 1930 through 2021, S&P 500 corporate earnings were positive 61 years, negative 31 years. So about a third of the time, earnings are down from the previous year. If you only invested in the stock market during those years where earnings were up, your returns would have been 10.2%. If you only invested in the years where earnings were down, you would have made 9.8% on average. So identical. So the path of earnings doesn't necessarily tell you what stocks are going to do in any given calendar year. So yes, we know earnings estimates are too high. They are coming down, have been coming down all year. That will continue, but that doesn't necessarily translate into a sell.
Okay, so two things I want to touch on there. I love that. I love when he brings out that data and says that, basically whether it's up years for earnings or down years for earnings, you get about the same return. That's interesting, right? I think part of that reason is because the stock market goes down usually going into earnings going down, right? Which is very similar to what we've seen in 2022. NASDAQ down 34% plus year to date. It's probably doing that because it believes, the belief is, regardless of what people feel of this and that, it believes that earnings are going to be down over the next year, right? That's why it pushes down 34+% in year to date, right? So I think that's very telling there. Second part is we're going to have a haves and have-nots market. There's going to be some companies that definitely have down earnings, in 2023 versus, 2022 or over the next couple quarters. There's going to be some companies that our earnings picture gets way better. There's several small cap stocks I own that their situations are going to get far better. The losses those companies take are going to be way less than basically in 2022. And the reason being is so many costs of what's going into their business has come down dramatically over the past 6+ months, essentially. And so they'll actually be in a much stronger, better position in 23 on top of what's going on in their businesses. So it's going to be a haves and have-nots market. Hope you guys enjoyed this video. As always, thank you so much for everybody that's subscribed. I appreciate each and every one of you that subscribed to this channel. Thank you. Thank you. If you're looking to join us in the private stock group and get access to our Discord chat, all the different Discord chats out there, as well as our private group investor report and all my different course curriculums, check out the pinned comment down there to apply to join us in there. Much love as always, and have a great day.